Ready to pass the CPA exam faster? Visit cpapass.ai. Today, practice calculating ROA and ROE, the average balance trap. Welcome to this FAR exam breakdown. Many candidates lose easy points on return on assets and return on equity questions because they fall into the average balance trap. And when a CPA exam question provides both beginning and ending balance sheet numbers, the examiner is testing your attention to detail. A classic distractor answer choice is calculated using only the year-end ending balances. If you grab these numbers directly, you will select the wrong option. To succeed, you must master the average balance calculation and understand when to adjust net income for preferred dividends. Today, we will walk through a realistic FAR practice problem to ensure you can calculate both ROA and ROE accurately in under 4 minutes on exam day. Okay, so let's break down return on assets, or ROA. The formula is net income divided by average total assets. Why do we use average assets instead of ending assets? This comes down to the matching principle. Net income is earned over an entire period, whereas assets on a balance sheet represent a single point in time. To match them properly, we must average the assets over that same period. Calculate average total assets by adding beginning total assets to ending total assets and dividing by 2. The examiner's favorite trap is providing only the ending assets in a simple list, hoping you will skip the averaging step entirely. Using only ending assets will lead you straight to a highly attractive distractor choice. Next, we examine return on equity, or ROE. The basic formula is net income divided by average stockholders' equity. While ROA measures how efficiently a company uses all its assets, ROE measures the profitability generated specifically for the owners of the business. To calculate the denominator, take beginning stockholders' equity, add ending stockholders' equity, and divide by 2. Do not make the mistake of using only the year-end equity balance. Remember, because equity represents only a portion of how a company is financed, the denominator for ROE is smaller than that of ROA. Consequently, a company's ROE will almost always be a larger percentage than its ROA. Keep this relationship in mind to sanity check your final exam calculations. Now let's address a high-frequency examiner trap, the preferred dividend adjustment. When a CPA question asks for the return on common equity, you cannot simply use net income as your numerator. You must isolate the earnings actually available to common shareholders. To do this, you must subtract preferred dividends from net income in your numerator. Furthermore, you must ensure your denominator represents average common equity, which excludes preferred stock. Many candidates fail this concept because they copy net income directly from the prompt without adjusting for preferred dividends. If you see preferred dividends or preferred stock in a problem, treat it as a flashing red light. Always adjust your numerator before dividing by average common equity. Let's apply these rules to a worked example. Imagine a company with net income of $80,000, preferred dividends of $10,000, beginning assets of $400,000, and ending assets of $600,000. Beginning common equity is $200,000 and ending common equity is $300,000. First, calculate average assets. $400,000 plus $600,000 divided by 2 equals $500,000. ROA is $80,000 divided by $500,000, which equals 16%. Next, calculate average common equity. $200,000 plus $300,000 divided by 2 equals $250,000. Subtract preferred dividends from net income to get $70,000. ROE is $70,000 divided by $250,000, which equals 28%. To wrap up, let's review your exam day checklist for these critical profitability ratios. First, always check if the question provides both beginning and ending balances. If it does, you must calculate the average by adding them together and dividing by 2. Second, when calculating return on common equity, always subtract preferred dividends from net income in the numerator to isolate earnings for common shareholders. Third, double check that you have not accidentally swapped your denominators. Remember, ROA uses average total assets, while ROE uses average stockholders' equity. Master these adjustments, watch out for the ending balance trap, and practice additional simulations on cpapass.ai to ensure you secure these highly testable points on your FAR exam.